Though America's most popular mortgage is the 30-year fixed-rate mortgage, it is not your only option. There are several factors you will need to consider when you decide how long you want to spend paying off your mortgage. It may seem obvious to base your decision on the best interest rate and the lowest monthly payment, but there are several factors that affect your financial future. Two of the most common options are a 15-year and a 30-year mortgage. Each one has unique pros and cons, and your choice could affect your finances for many years to come. Here's what you need to know about these two popular options. The 30-year mortgage, also known as the 30-year fixed mortgage, are loans that are paid off over the course of 30 years. The fixed part means that interest rate is locked when you sign the loan. It won't change based on market interest rates, like an adjustable rate mortgage will. That does not mean you're necessarily stuck with the initial interest rate for life though. You can choose to refinance in future to get a different interest rate if that makes financial sense for you. A 30-year mortgage is the most popular type of mortgage in the US, with 90% of mortgages lasting 30 years. Because 30-year mortgages will significantly lower your monthly payment than a 15-year mortgage, they are often more affordable for home buyers. Keep in mind though, you will end up paying more interest over the life of the loan. Like 30-year mortgages, 15-year mortgages are also fixed. You will be paying off the loan in 15 years instead of 30. These short-term mortgages have a higher monthly payment but lower interest rates and a shorter term loan, which means you are paying less over the life of the loan. You will also build equity in your home faster. While 15-year mortgages are less common than 30-year mortgages, accounting for only 6% of the market, that does not mean you should not consider one. If you can afford a higher monthly payment, a 15-year mortgage can help you save thousands in the long run and be debt-free sooner. You typically get a better interest rate by doing a 15-year term. The difference between a 15-year and a 30-year mortgage rate can be around 0.5% according to recent averages. However, over the life of the loan, that half percentage point can add up to a difference of nearly $100,000. Here's the math. On a $240,000 loan, a 30-year mortgage with a 4% interest rate would come with $172,000 in interest over the course of the loan. A 15-year mortgage at a 3.5% interest rate would come with $69,000 in interest over the course of the loan. Your monthly cost, however, is a different story. Even though you're paying less overall with a 15-year mortgage, your monthly payment will be significantly higher because the loan amount is stretched over a shorter time frame. In the example above, the monthly payment, excluding fees and taxes, for the 15-year mortgage would be just over $1,700, while the monthly payment for the 30-year mortgage would be just over $1,100. For most people, the difference in monthly payment could make all the difference. A lot of first-time home buyers these days have a lot of student loan debt that has to be taken into account. Getting a 30-year mortgage is the difference between being able to buy a house that's theirs versus not being able to buy a house at all. Besides the cost, the biggest difference between a 30-year mortgage and a 15-year mortgage is obvious: the length of time it takes to pay off your mortgage. With a 15-year term, you will be making half as many payments, so those payments will obviously be higher. With a 30-year term, you're spreading the amount over twice as many payments, which means you're paying more interest over time. Overall, a 15-year term is a better deal. If someone has the financial capacity to take on a 15-year, it is at least worth exploring. Start with a payment that fits your budget. Many people buy according to a monthly payment. A 30-year mortgage may help you afford a more expensive house, but that does not mean it is the best option. However, how much do you plan on putting in down payment? A larger down payment helps make either a 15-year or a 30-year mortgage more affordable in terms of monthly mortgage payments. Then, how long do you plan to stay in the home? A shorter term helps you build equity in your home faster because the payments aren't as front-loaded with interest as a 30-year mortgage. Do you have short-term or long-term goals for your equity? For short-term financial goals that would benefit from tapping your home equity, a 15-year mortgage gets you there faster. A 30-year mortgage still builds equity, but is more suitable for long-term planning. How does your mortgage fit with other financial goals? Factor in other debts and saving goals when determining the size of your mortgage. There's a good reason that the 30-year mortgages are typically the more popular choice for homeowners. They come with lower monthly payments and can provide more purchasing power. While 15-year mortgages do have some advantages, especially when it comes to paying less overall interest, the higher monthly payments may be difficult for most borrowers to swallow. However, if you do end up with a 30-year mortgage, it is a good idea to try and make extra payments on your loan each year if you can. You can either plan out a faster overall payment plan or just make an extra payment whenever you have the money. Either way, those extra payments will help you save on interest and potentially give you the best of both worlds.